How to get a deal in real estate in 2023. On this episode of the Stephen Rotsart podcast, we're going to dive deep on what's going on in the real estate market and how you might be able to expand your real estate portfolio. Stay tuned. Welcome to the Stephen Rotsart podcast. I'm your host, Stephen Rotsart, and I'm here to provide you value. From my years of real estate experience, I'm here to provide you tips and tricks in the real estate industry and to have guests on that have impacted my life and that I think that you might be able to benefit from too. Stay tuned. Welcome back to the podcast. Today I wanted to take some time and kind of go deep into what's going on in the real estate market, and specifically from a real estate investor side. The mortgage market has been highly volatile since the beginning of the year. And so we've seen rates go all the way up to basically 7%, come back down. Most recently, within the past 3 weeks of the filming of this podcast, they dipped under 6% for the first time since last year. And now we're back up hovering right around 7%. Why is that so critical for real estate investors, even a home buyer in this marketplace? Is because for all intents and purposes, inventory is low across the board, but you are going to have some very motivated sellers. And as interest rates and mortgage rates creep up higher, the buying pool at certain price points shrinks and it just gets smaller and smaller. And so you have sellers that are willing to be able to negotiate with a buyer specifically on terms, whether it be for credits, whether it be for any types of repairs or anything of that nature. So there's an opportunity where we're seeing this is especially really evident in the real estate investor market. Now, I tell every single one of my clients, hey, never sell your principal residence. If that's an option in your portfolio, try and keep your principal residence. If you live in your principal residence for 12 months after you purchase it, you can refinance out of your principal residence and use the money that's been made based on equity and put that on a down payment of another property. And then you can turn your original home into an investment property, into a rental. Why is that actually just good advice at this point? Things that we're seeing in the marketplace. Well, there's a lot of money coming into the real estate space. Firms like BlackRock, Chase Bank announced $1 billion to buy residential housing. Well, they are trying to make a society of renters. And so if you can own your own tangible asset, you're ahead of the game. And if you can become one of those people that is a landlord, there's a lot of advantages with that. Outside of passive income, and now have a tax shelter as well. The IRS treats rental property much like a business. So every single property is basically its own business in the way it operates. And you can go ahead and deduct the expenses of that property based on what you have to do there, whether it be landscaping, repairs, things of that nature. But let's get back to the specifics of where we're seeing the opportunities in 2023. There are a series of iBuyers, especially in my area, and I'm sure this happens everywhere across the United States, and you can reach out to your local agent and they can probably provide you some data on this. But at the time of this recording, there were almost 200 single-family homes that were owned by Opendoor, okay? Now, Opendoor is a company that comes in and gives you a cash offer for your property, and that way you never have to put your property up on the market or do anything and inconvenience yourself. And I've actually had clients that have used this system, and it can be a good system for the right circumstances. But that being said, we're going to talk about it from a buyer's perspective. They are liquidating property as fast as they can. Just this last week, Opendoor announced a $400 million loss at the end of the year in their iBuyer program. And they are now partnered up with Zillow to basically take care of what Zillow's home buying arm of their program did. Opendoor's now taking care of it. So I don't see a lot of that really changing where there's a possibility that they could be overpaying for property. Now, there are some other third-party iBuyer systems. I'll probably shoot another podcast. We'll get deep into that about why you should not sell your home to an iBuyer without consulting a real estate professional in this marketplace, because that has been an absolute nightmare for people that I end up talking to after the fact. But let's get into specific opportunities. With Opendoor here in my area, with over 200 homes that are owned by them outright, and they are looking to liquidate. Some of these homes have been on the market over 6 months already, and they are just trying to get rid of the asset. So you're going to see opportunities as a buyer in this marketplace to purchase homes like that. Now, the catch to it is you're probably going to get a deal on price from a seller like Open Door, but you're not going to get repairs or anything of that nature. Now, the property's probably been maintained or semi-repaired if there was a deficiency that was discovered by one of these programs, but really you're going after the price more than anything. The other thing is, outside of the iBuyer programs that exist in this marketplace, that there's going to be, and there currently is, inventory in the marketplace to get those deals, you're going to have sellers that are very serious, okay? And as interest rates creep up, and here we are back almost to 7%, sellers will negotiate with you. Sellers will give you credits. And we're going to be back to where we were just a month or so ago, talking about 2-1 buy down programs or 3-2-1 buy down programs, where a seller actually gives the credit to buy down the loan for a buyer to make sure that the property can sell. The appraisals are still coming in at value. The numbers are holding roughly across the board. Now, you're going to see in some of my statistics, if you follow me on social media and you look at Instagram, you're going to see some of the stats there that show month over month, there's a little bit of a fall off. Well, that's kind of the median price range across the board in certain zip codes. But all in all, we're not seeing the county of San Diego as a whole depleting because there's just not enough inventory. And how can I document the amount of inventory? Well, basically, to be in a normal market, statistically, it will tell you that you need to have 6 months worth of inventory to basically be in a balanced market. And right now, in most communities and zip codes in my neighborhood, everything is hovering 2 months or less. Well, that's still going to give it a seller's market to a certain degree, but the buying pool is a lot smaller when interest rates start to creep up, because the price to purchase a home at a 6% interest rate as compared to a 7% interest rate just went up for that particular buyer. Now, from a real estate investor's perspective, this is key because there's so many loan programs right now for investors that are fantastic. So let's start first. The simple one is that you elect to go ahead and buy a new home and vacate the residence that you're in, and you're going to refinance out of that one. Now, currently, that interest rate's going to be at roughly almost 7%, but now it's going to become a business. The other catch to that whole thing is the following. If you do vacate your principal residence, the tax code does allow you 2 years to go ahead and sell that property. If you've lived in it 2 out of the past 5 years, you still have a capital gains exemption on that property if you still elect to sell it even after the fact. But you have a ticking clock of how much time that you have. So pay attention to that if you elect to not keep it in your portfolio. But let's say you refinance and you go find another principal residence, and now you basically just use that money for your down payment. It's a great way to start a real estate portfolio. The other thing is that there are loan programs right now that really have nothing to do based on buyer qualifications. It has to do with property qualifications. So what lenders are doing right now is they're actually looking at a snapshot of the income and expenses that are going on at each individual property. And the loan is qualified based on that data. Now they're going to turn around and go, okay, well, based on this data, you're going to have to put 20, 30, 40% down. But the qualification is based on the property. The qualification is not based on the buyer themselves and their credit worthiness. The worthiness is based on the property. So there's so many loan programs now that people have an opportunity right now to create generational wealth in real estate. And I think this is going to be an opportune time over the next 90 days to 6 months. You're going to see a shift here in 2023. The jobs market is kind of confusing. We have reports of a fantastic jobs market. And then if you turn on any channel, you're always going to see that another company is laying off employees. Well, the issue that we have, and especially where I live, we have the opportunity for remote work. And that's kind of changed the dynamics of our housing environment. We have people that relocated here during the COVID timeframe and are now calling San Diego home, and they're telecommuters or remote workers. And maybe they work for a company in Northern California. Maybe they work for a company out of Arizona. Well, those are only 1 hour flights away. So if they still have to get somewhere, really they can still get there within the same day time frame and commute back. But that's really changed the landscape of our marketplace. I know that a lot of Californians leaving California have impacted other markets from Idaho to Arizona to Texas to Tennessee, even Florida. We moved 22 families ourselves last year out of California. And one might say, well, why would you do that? Why are people leaving? There's so many different reasons, but we also brought in 14 people from out of state into San Diego County. A lot of them were East Coast based. And a lot of it had to do with tax rates, income tax rates and things of that nature. The people that arrived here, even though Californians complain about the income tax rate here, it was still cheaper than where they lived on the East Coast. So there's some specifics of why there's this migration of different people. And I don't think that's ever really going to end. I think you're always going to find people that are migrating either to family or they're migrating for different reasons for their children and trying to find a different environment. Maybe they can afford more home, a bigger parcel, things of that nature. So with that, there's a lot of opportunities that still exist here, especially in San Diego County where I work, where real estate investors are going to have an opportunity right now in 2023 to seize opportunities in this marketplace. And I really feel that that's going to make a huge difference for each individual family. Right now, what we're seeing is generational wealth being made because we're seeing families combine and live under one household and start renting out the other properties that the family had in their portfolio. The other thing that most properties in San Diego County qualify for is specifically, and especially areas that I work, which is in the San Diego's East County portion. SB 9, which is a state bill for the state of California, allows a density increase on these parcels of land. So we started with a few years ago, the state said, well, every property is eligible to have an ADU, which is an additional dwelling unit. Some people might call it a granny flat, but in real estate terms, we would call it an ADU or an additional dwelling unit, a secondary house. And every parcel in California was allowed to have that, subject to the local governing code compliances. And some properties fit it, some people it wasn't able to qualify for, but most of the areas that I do business in as a real estate agent, these actually did qualify. And we're seeing the propensity of that from a real estate investor's perspective, because now you can buy a property and maybe it's a double lot. And what I mean by a double lot is maybe it's twice as deep or twice as wide as the average lots in the area. And let's use some hypothetical numbers, but let's say a lot is 6,000 square feet and all of a sudden you found one that's 12,000 square feet. Well, right now you could put 2 more units on those types of properties. And we're seeing a lot of investors do that. There's one group here in San Diego County that actually is demoing certain properties that have lot size that big and putting in more units. And, I think the last one that I saw that they did was a total of 2 units that they turned into 12 because of the density increase that they were allowed. So these are some of the things from an investor's perspective that really can create generational wealth. Yes, it's going to take time to be able to, get permits and things of that nature to process those, to be able to rehab and remodel a property, to go ahead and upgrade it. But everywhere you look, they're even selling kits now for additional dwelling units. You can buy a $30,000 kit on Amazon. I think Home Depot is drop shipping now. I think one of the nicest ones that was fairly average that I saw was $15,000 on Home Depot. So things of that nature do exist as an opportunity for a real estate investor, that if you have the right property and you get a good deal on it, there's actually additional options for you to be able to go ahead and create additional rental income. So if you can put an additional dwelling unit in the back of the parcel, go ahead and rent that space out too. It's a fantastic way to have a real estate portfolio, or start a real estate portfolio if you don't have one, and be able to live off of passive income in the future. And it's a way that a lot of our clients we call them real estate portfolio or portfolio management, have been able to take their real estate assets and move them or go ahead and upgrade them over a period of time to allow for larger amounts of passive income to come in monthly. And so by the time they get of an age of which they're interested in retiring or things of that nature, they're not really even living off their retirement. They're living off the passive income of the units that they have. So it's a great way to be able to do that. The other thing is too, especially here in San Diego County, we have several universities. We have families that are actually purchasing property and going ahead and renting rooms out for additional income to be able to offset the cost of that property to other students. And it's another great way to be able to start a real estate portfolio and have passive income that way to take out some of the sting from the mortgage payment and things of that. So 2023 is going to be an opportune time of generational wealth, and you're going to see a lot of opportunities in real estate. I'm always here to answer any questions that you might have, but pay attention to those things. I'm going to continue to put out some more information on the opportunities that are going to come up and that will exist in 2023 for clients, not only here in California and San Diego County specifically where I work, but across the United States, because we're seeing this statistically as a whole across the entire country. So pay attention to those things. I look forward to sharing those things with you, and be on the lookout for the next episode. Thanks for tuning in today.